keep in mind, when that silver leaves the COMEX, it doesn't come back. Look at that. That's the COMEX gold inventory. It looks even different than the silver, doesn't it?
Yeah.
This is where over 25 million ounces disappeared in 24 hours. You saw that big drop off. And that's really why silver is the fuse. They changed SLV to just reflect the spot price. They couldn't get their hands on enough physical silver to put those baskets together, because gold is the anchor, because gold is what protects you from it. But look at the massive dips. I'm telling you right now, what we're looking at here is significant. Entities are standing for delivery. Just like silver, there is a finite amount of it. So demand is increasing. Even as the spot price, after it peaked, it dropped. And people are, oh, well, maybe gold isn't, because that's not gold. That's a contract. That's what central banks and smart money is actually doing. This is the COMEX silver inventory. And this is just going back for a year. So you can see that massive decline. So regardless of the spot price, which is just about keeping you away from the actual physical metal itself, how many times can you be lied to and you do not know the truth? What we're seeing is physical demand continues to escalate. And of course, we do know that there are a lot of entities that use just a finite silver, 36 of them. But almost in this last year, you've had what? Over 312 million ounces. Actually, that's the last 24 hours, just disappear. And again, for silver's use, there is a finite amount, but in the meantime, there are 36 different physical users. So don't believe the fiat money lie on the contracts, because they can create as much silver that does not nor ever will exist, but those users don't go away. And so the volatility that you see in the markets, it's really silver telling you that something major is going on. But keep in mind, when that silver leaves the COMEX, it doesn't come back. And before we go on to silver or on to gold, do you want to make a comment and say something about this?
Yeah, I mean, that is a very big, change in the trend when we see that large dip down in the physical holdings that the COMEX has. And it kind of goes back to what we talked about last week as well, when people can stand for delivery of those contracts of the COMEX.
Silver inventories are collapsing while financial headlines keep pretending supply is stable. According to Lynette Zang, more than 300 million ounces disappearing from COMEX inventories is not normal market volatility. It signals rising stress inside the physical delivery system. Wall Street keeps directing investors toward paper exposure, because paper can be expanded infinitely while physical silver cannot. The danger for savers is that spot prices may stay artificially calm right until actual deliverable supply becomes difficult to source. Next, Lynette Zang exposes why physical delivery demand is starting to overwhelm the futures market illusion.
So we're seeing this now play out more in real time, where maybe there's people that want to take the physical delivery over rolling it over into another futures trade or keeping it as fiat. So would you say, Lynette, that that's maybe a sign too of that public confidence piece being lost in the fiat?
Yes, I would absolutely call this a sign. And that's really why silver is the fuse. It's more volatile. It reacts first. Though when I was looking in the gold contracts, that was also like really interesting. I'm going to go through this quickly. And just a reminder, because when I did the event, the Plutus event last week, somebody came up to me and said, you know what image made the biggest impact on them was this chart and the one on the gold, where you're actually listing out the users, because people don't really think about that. But when you see the big spike and that's not the users,
right?
That's the traders. And soon, I can't tell you when, because who knows, but at some point in the reasonably near future, well, what's going to happen is it will be the physical true supply and demand that dictates the prices.
Yeah.
But let's do the same thing with gold, right? Look at that. That's the COMEX gold inventory. It looks even different than the silver, doesn't it?
Yeah, absolutely.
It drops off that cliff, and you can see something even bigger than that. There are, let's see. Yeah, this is where over 25 million ounces disappeared in 24 hours. You saw that big drop off again with the users. But
COMEX gold inventories just suffered a massive drop while official narratives still insist markets are functioning normally. Lynette Zang notes that traders rolling contracts is no longer the dominant story because more participants appear to want actual physical delivery instead of paper promises. That shift matters because futures markets depend on confidence staying intact, not on every ounce being physically available at once. If confidence breaks faster than inventories can replenish, ordinary investors holding synthetic exposure may discover their protection was largely theoretical. Next, Lynette Zang reveals the hidden divergence between gold inventory trends and public confidence in fiat markets.
I am going to show you what is happening in the long term on the gold chart, which I did not see the same pattern in the silver.
Yeah.
Look at this.
Wow.
That goes back to 1993, right at the very beginning. And you can see the major pattern shift that happened in 2020. And actually, even 2008, it didn't change that much. But look what happened in 2020 with that massive upswing. And then again, in 2025, when we really started talking about the shift that's happening between the digital and the physical markets.
Yeah.
You want to make a comment? I mean, because have you seen this? Or is this the first time you've seen this chart?
Yeah, this is the first time I've seen that. And I mean, it really does show. So you've got this huge dramatic change in 2020. And then that was just barely 5 years ago. When you see now it went down, but it made a higher high. Right. And so that I think is very telling of when, like you said, it's a pattern shift, and it's something that to me looks like it's getting more volatile, right? If you're getting the ups and downs.
Well, yeah, but what are we looking at here? We're looking at the COMEX gold inventory.
Yeah.
That's what we're really looking at. So in the beginning of 2020, do you remember they even had to, they changed SLV to just reflect the spot price, right? Because they couldn't get their hands, and they still can't. It hasn't gotten better.
The last time inventory charts shifted this violently, central banks quietly flooded the system with emergency liquidity. What Lynette Zang is highlighting here is that the 2020 pattern change never normalized. It accelerated into 2025 with even larger swings in physical gold movement. That suggests the market structure itself may be becoming more unstable beneath the surface calm of official pricing. Investors focused only on stock indexes are missing the deeper signal. Institutions appear increasingly concerned about securing hard assets before the public fully notices the shift. Next, Lynette Zang unravels why ETF structures changed once physical metal became harder to source.
They couldn't get their hands on enough physical silver to put those baskets together. But what this is really showing is I think, is the final breakdown, because I was convinced in 2008, I remain convinced today that 2008 is when the system actually died. But from 2020, and you remember what was happening in the futures markets and all of the markets, there was this flight to safety. They had to build their inventory. Right? Why? Because gold is the anchor. Because gold is what protects you from it. But look at the massive dips. I'm telling you right now, what we're looking at here is significant. It's very significant. Entities are standing for delivery. And just like silver, there is a finite amount of it. Now, I didn't have a chance to put these slides together, so kind of bear with me in there. But you see this dark line. Oh, you were not going to see it there. Wait, I have a laser here, right? If I point it here, does it work? No. Okay, the laser doesn't mean anything. But the first quarter of 2026, there was higher demand. Right? That's a 5-year average. That line that you see in there is the 5-year average. So demand is increasing. Even as the spot price, after it peaked, it dropped. And people are, oh, well, maybe gold isn't, because that's not gold. That's a contract.
Yeah.
You've got the physical gold right by you, right? Did it evaporate? Did all of those users magically disappear?
No, and it didn't change either.
Exactly.
Nothing changed about the actual physical asset.
Gold demand is rising even while paper prices send investors the opposite emotional signal. Lynette Zang's argument suggests a disconnect between falling spot prices and rising physical demand exposes how detached futures pricing may be from real-world scarcity. Institutions do not rush to secure gold inventories during stable monetary periods. They do it when confidence in the system quietly deteriorates behind closed doors. For long-term savers, the real risk is waiting for mainstream confirmation after strategic buyers have already accumulated the remaining supply advantage. Next, Lynette Zang reveals why physical demand trends are directly contradicting the public inflation narrative.
Yep. So you want to get your strategy laid in, because that's what central banks and smart money is actually doing. And here, central bank buying remained elevated in Q1 alongside of a pickup in reported sales. So understand that that is savings. Gold is your savings. And so when a country gets into trouble, they have savings to fall back on.
Yeah.
I have a huge bugaboo, because one of the things that I've seen over time, and I really want your input on this, because you're a different generation than I am. But in my generation, we were really taught to accumulate things, right? And then when you run into a problem, you have savings, you have something to fall back on.
Yeah.
But more into your generation, weren't they encouraging you to just accumulate experiences?
Yeah.
Right?
Yeah.
And I'm not saying don't have those experiences, but if you spend all of your wealth on experiences and you have no hard assets to fall back on, you
Right.
have no savings to fall back on, what do you do?
Yeah. And I think that also goes into something that you've brought up before. These, buy now, pay later companies, or pay in installments.
Yeah.
It's a way to get, younger generations, those consumers, to not think about what they're doing so much. Like you said, don't worry about it. You don't need a hard asset. If you can't afford to pay for all of it right now, we can just break it up into 12 easy payments for you, or 4 easy payments.
Yep.
And so that's very true.
Central banks are still accumulating gold, while consumers are being pushed deeper into installment debt culture. This is where Lynette Zang's thesis shifts from metals into behavioral conditioning, because the system increasingly rewards spending while quietly punishing long-term saving. Governments hold hard assets as strategic reserves, yet ordinary people are encouraged to finance lifestyles through recurring payments and depreciating consumption. That divergence matters because financial resilience disappears fast during inflationary cycles when households own liabilities instead of tangible stores of value. Next, Lynette Zang exposes why institutional gold accumulation contradicts the public narrative around economic stability.
It's one giant revolving door of debt, and the question then becomes, especially when you see that chart where the COMEX the inventory, right? It's going up and then it goes back down.
Right.
I think that we're seeing something big there. Yeah.
We are seeing something huge there.
Yeah.
And it's the inventory that they're pulling in because they know the COMEX is about contracts. It's not about physical delivery.
Right.
But there are enough of their entities that are going, look, we're going to tell you right now, we want physical delivery.
Yeah.
So here's, you can take that off now. Thank you. Because here's the other part of that. We don't have that physical delivery here. Where is all that gold coming from? Kind of like we talked about in 2025. And once that is delivered out from Europe or Switzerland or wherever it's not coming from China, that's for sure.
Right. Yeah,
Right?
they're not letting it go.
No, they're not letting it go.
Yeah.
But once that inventory comes into the COMEX and then gets delivered out, well, did they buy that outright? Did the Bank of England send that in from I don't know, the government's gold that they're holding? Right?
Yeah.
I'm telling you, the fireworks will be huge.
Yeah. I mean, do you think that there's like a layer of illusion that the COMEX always has to try and keep up?
Well, yeah. They don't want you to know what's going on.
Right.
The guys that they want, it's kind of like the FDIC. You know, the big kahunas, they're the ones that are driving all of this. They know what's going on.
Markets still price gold like a liquid paper asset, even as physical inventories appear increasingly strained behind the scenes. As Lynette Zang points out here, COMEX was designed around contracts and leverage, not large-scale physical withdrawal requests from participants demanding delivery at the same time. The overlooked issue is where replacement inventory actually comes from, once sovereign reserves and foreign vaults become less willing to release metal into Western markets. Retail investors trusting paper exposure alone may discover too late that liquidity and deliverability are not the same thing. Next, Lynette Zang reveals why central banks may already be preparing for a confidence shock in paper markets.
That's all that really matters.
Yeah.
The little guys breaking those contracts down into 1 ounce pieces so that the normal guy can afford to support the market,
yeah.
Right? What do? They privatize the gains and they democratize the losses.
Yeah, that's that shift of the risk, right? That risking shifted away from them onto everyday people like you and me and everyone watching.
The people that believe and continue to believe the lie.
Yeah.
So I'm telling you, don't believe the lie. And you can be lied to every single time unless you know the truth. And we just showed you what's happening in the COMEX with the physical inventory.
Yeah.
It is telling you to get your strategy in place. Get it done while we still have that option. Because we don't have all the time in the world. We only have as much as we have. Now, I do know that there was something that you wanted to bring up as well. Was there?
Yeah. It just was interesting. About maybe an hour before we were supposed to go live, there was some breaking news, I guess, on the Kevin Warsh he cleared his Senate hurdle for being instilled as a governor at the Federal Reserve, and then as early as tomorrow, he could actually get that chairman vote. And just to see if that regime change, because that's what he's saying he wants to see. If it
well
at the Fed,
yeah. It's really interesting because the CPI, the inflation numbers came in hot.
Yeah, a little hot.
We talked about it, right?
The system socializes losses for the public while concentrating real asset ownership among institutions and insiders. Lynette Zang notes that shrinking COMEX inventories matter because they expose a widening gap between what retail investors believe they own and what can actually be delivered under stress conditions. Meanwhile, inflation remains persistent enough to complicate rate cuts even as policymakers continue signaling stability and control. For ordinary savers, that contradiction creates the exact environment where purchasing power erodes quietly, while financial assets appear superficially healthy on the surface. Next, Lynette Zang unravels why inflation data may be forcing the Federal Reserve into an impossible policy corner.
Of course, they're going to come in hot. We're at the end of this currency's life cycle. why can't they control it by raising rates? But the markets don't like higher interest rates.
Yeah.
So it has nothing to do with valuations, but it makes it harder for anybody to justify lowering rates.
Right.
Because lowering rates is about inspiring borrowing and spending, which inspires more inflation. And that's why they have a hard time lowering rates when core PCE, which I mean, it's garbage anyway.
It's their magic number, and it still came in hot with their magic number. So what's the real number?
Exactly.
Is what I think. Yeah.
Exactly.
Yeah.
And in the meantime, I think they did some calculations on the average wage earner and how much they actually have lost out. So things are costing more. And because of those things that are costing more, the people that can least afford it, that need that 4 easy payments, right? Those poor people are hurt even more.
Yeah. Right. Yeah, it's almost like it's by design, right?
Well, it is by design. But you know what they don't want to have happen, but I don't think that they can avoid it? That is that loss of confidence. This is a con game.
Yeah.
So we already hit recently the lowest level ever in consumer sentiment.
Yeah.
So at least since they've been tracking since 1952. So what do you think this is going to do to impact? They're not looking at the numbers. They're people are just trying to make ends meet. They're just trying to figure it out. But if things are getting more expensive and your paycheck goes less and less and less far when you're already having trouble meeting those ends meet, what does that do?
Consumer sentiment is collapsing even while officials continue insisting inflation is gradually under control. According to Lynette Zang, the deeper problem is not just rising prices, but the policy trap forming around interest rates, debt dependence, and weakening public confidence simultaneously. Historically, late-stage currency cycles become unstable when central banks can neither tighten aggressively nor ease without reigniting inflation pressure across the economy. That leaves average households trapped between higher living costs, stagnant purchasing power, and financial narratives that no longer match everyday reality.